Japan is not collapsing with explosions, protests, or a dramatic revolution. Japan is collapsing quietly, politely, and on schedule. And that is exactly why the rest of the world should be terrified. Because Japan is running into a problem that money cannot easily fix. Japan is running out of people. And once an economy runs out of people, everything you thought you understood about growth starts to break. Here is the shocking part. A country can have customers ready to pay. A country can have money in the bank. A country can have world-class infrastructure. And still, businesses can shut down simply because there is nobody left to keep the lights on. Japan is also shutting down hundreds of schools because there are not enough children to fill classrooms. And while Tokyo still looks crowded, the national trend is going the opposite direction. Japan's crisis is not too many people. Japan's crisis is too few. But Japan wasn't always the cautionary tale. Japan was once the economic miracle that scared America. Japan was once the machine that turned post-war ruins into global dominance. So the real question is not whether Japan is struggling today. The real question is how a miracle economy turned into a long, slow emergency. To answer that, we need to start with the timeline. This story begins after World War II, when Japan's major cities were destroyed and millions were starving. Japan was politically fragile, economically shattered, and socially traumatized. And in the early Cold War, that made Japan strategically priceless. The United States looked at Asia and saw a contest between capitalism and communism. The United States feared that if Japan collapsed into desperation, extremist ideologies could fill the vacuum. So Japan stopped being treated like a defeated enemy and started being treated like a strategic investment. America helped rebuild Japan's industrial base. America opened its consumer market to Japanese exports. America supported Japan's integration into the global capitalist system. And Japan did what Japan does best. Japan industrialized with discipline. Japan improved manufacturing with obsessive quality. Japan mastered consumer electronics, automobiles, and industrial components. Japan became a symbol of how fast a nation can rise when technology, labor, and trade align. By the 1980s, Japan wasn't just winning. Japan was threatening to overtake the United States in global economic dominance. Japanese companies surged in global rankings. Japanese cars captured huge market share. Japanese semiconductor firms challenged American leadership, but success created backlash. American workers saw Japanese imports as job killers. American politicians saw Japan as an economic threat, and American policy began to demand a rebalancing. This is where one event becomes a turning point in the modern economic story. In 1985, the Plaza Accord changed currency dynamics in a way that shocked Japan's export model. The yen strengthened dramatically relative to the dollar, and Japan's cost advantage weakened almost overnight. When your economy depends heavily on exports, currency shocks hit like a sudden earthquake. Japanese goods became more expensive abroad. Export momentum slowed, and Japan needed a response that could prevent a collapse in growth and employment. Japan's response came through lower interest rates and easier credit. The goal sounded reasonable. Make money cheap so companies can invest in productivity and innovation. Make money cheap so the economy can adjust to the new currency reality. But cheap money has a dark side. Cheap money doesn't always flow into innovation. Cheap money often flows into assets. Cheap money loves speculation. In Japan, credit flooded into stocks, land, and real estate. Asset prices began climbing beyond what normal income and profits could justify. The stock market soared, land values exploded, and a dangerous illusion formed across the country. The illusion was that Japan had discovered a new economic law. The illusion was that asset prices could rise forever. The illusion was that debt was safe because the collateral was always growing. Companies began earning profits from trading instead of their core products. Banks became comfortable lending against inflated assets, and speculation started to feel like national destiny. Then the cycle snapped. Interest rates rose, the cost of money increased, asset prices stopped climbing, And once the belief breaks, a bubble doesn't gently deflate. A bubble collapses, stocks fall, property values drop, balance sheets rot, and debts that looked harmless suddenly become life sentences. This collapse did not just destroy wealth, it destroyed confidence, it destroyed risk-taking. It destroyed the idea that tomorrow would be bigger than today. But Japan's biggest mistake came after the crash. Japan tried to prevent failure at all costs. And that sounds compassionate until you see what it does to an economy. Instead of letting weak companies die, banks kept them alive. Instead of forcing restructurings, Japan tolerated endless refinancing. Instead of clearing bad debt fast, Japan extended it slowly. This created an economy full of zombie companies. A zombie company is not dead enough to disappear. A zombie company is not alive enough to grow. A zombie company exists mainly to pay interest and avoid bankruptcy. Zombie companies do not innovate aggressively. Zombie companies do not hire boldly. Zombie companies do not raise wages meaningfully. Zombie companies suppress competition by selling at low margins just to keep cash flowing. And when zombies dominate, productivity slows across the whole system. New firms struggle to enter. High-growth ideas struggle to attract capital. Wages stagnate because profits stagnate. Consumption stagnates because wages stagnate. This is how Japan entered the era that became known as the lost decades. Growth stayed weak. Deflation pressured prices downward. Debt grew as the state tried to stabilize the system. And the country became one of the most indebted nations on earth. At this point, many people assume Japan's story is mainly about finance. But finance is only half the trap. The other half is demographics. And demographics move like slow-motion destiny. Japan's population began aging rapidly. A growing share of the country moved past working age. A shrinking share of the country entered the workforce. And the economy started facing a brutal arithmetic problem. Fewer workers means fewer total hours of labor. Fewer workers means fewer taxpayers supporting pensions and healthcare. Fewer workers means less production capacity unless productivity rises dramatically. And fewer workers means less consumer demand in the long run. This is where Japan's crisis becomes uniquely dangerous. Japan is not merely dealing with a recession. Japan is dealing with a workforce shortage that compounds year after year. Japan is dealing with a birth rate problem that cannot be reversed quickly. Now add a hidden social fracture that most outsiders miss. When Japan's economy weakened, companies reduced hiring of new graduates. This created a generation that missed the traditional pathway into stable careers. Many became stuck in low-security, low-wage positions without upward mobility. And when economic security falls, family formation changes. People delay marriage, people delay children, people avoid long-term commitments when the future feels uncertain. And that choice, repeated millions of times, becomes the demographic cliff. Japan also developed a paradox that looks absurd until you understand it. Japan can have labor shortages and still have underutilized workers. Japan can have open roles and still fail to match people to them. Because skills, geography, working conditions, and expectations do not align automatically. So Japan's problem is not only not enough people. Japan's problem is the mismatch between modern economic needs and a shrinking, aging labor pool. And when that mismatch grows, productivity suffers and innovation slows. Now let's zoom out into geopolitics. Japan's miracle economy was built inside a global system that rewarded exports. But globalization is no longer the same engine it was in the late 20th century. Trade is becoming more political. Supply chains are becoming more regional. Technology is becoming more restricted. Japan sits between major powers with competing strategies. Japan depends on global trade routes and stable energy flows. Japan also faces regional security concerns that demand defense spending and strategic alignment. And every geopolitical shock increases economic risk. Now consider the economic factors that make recovery harder. When growth is low, debt becomes harder to manage. When consumption is weak, private investment becomes cautious. When wages are flat, Households reduce discretionary spending. And when the population is aging, savings behavior and risk appetite change. In a young society, people borrow to build lives. In an aging society, people protect what they have. That shift changes everything from housing markets to startup culture. Now we need to talk about humanitarian and social aspects because numbers have faces. In an aging society, caregiving needs surge. Healthcare demand rises. Loneliness becomes a public health issue. Rural regions depopulate and lose services, and younger workers carry heavier burdens supporting an older majority. School closures are not just administrative decisions. They are signals that towns are losing their future. They are warnings that communities will hollow out. And they are psychological shocks that accelerate migration to major cities.